Small caps have traditionally been used by investors in times of economic prosperity as they provide opportunity for high capital growth. However, this asset class also provides great value in more subdued economies and over the long term. Joining me today to discuss his contrarian approach to small caps is Simon Conn, Senior Portfolio Manager and founding member of Investors Mutual. Welcome, Simon.
Thanks, Liz.
So, Simon, what are small caps?
Well, small caps by definition are companies outside the top 100. So in Australia we have quite a concentrated market where the large companies tend to dominate the index in terms of weight. And so in Australia we have a heavy concentration towards the banks and resources sectors. So when you look into the small caps outside the top 100, you can get a much broader opportunity set, and those companies below $1 to $1.5 billion market cap provide a much more diverse opportunity set.
And how can they be incorporated into an investor's portfolio?
Well, I think it's important to understand because of that diversity, it gives investors an access to various different earning streams. So they can access some businesses that have got potentially more growth opportunities than maybe some of the larger companies, purely because they're coming from a smaller base. It also gives investors the opportunity to access some really strong domestic or international franchises that have a small niche, and that diversifies the earning stream and the risks of investors.
So I understand small caps are typically used as part of a fast gains mentality for investors who want to get in and get out quickly and capitalise on trending sectors. What issues can arise from this approach?
Well, typically, you're right. So a lot of investors approach small caps in a very trading sort of mentality and do think of it more as a trading part of the market. But we think that that part of the market actually, and that approach really undersells the opportunity set you get in smaller companies. If you look at the characteristics of our portfolio over many, many years and the returns and the risk return characteristics we've been able to generate, we think a permanent allocation to this sector of the market can diversify the risk and also add good capital growth through time in a gradual way, but also allows investors to access good income streams that are diversified away from the banks and resources.
So is there a better way for small caps to be utilised?
Well, we think a permanent allocation or a dedicated allocation to small caps is a sensible thing. So as opposed to investors coming to the large caps and thinking it's buy and hold strategy, we think there's a sensible long-term capital appreciation and income can be generated also from the small cap sector. So we think investors should actually have a sensible long-term allocation to that sector.
Okay, and can you explain what IML's research-intensive bottom-up process involves and what value this provides for investors?
Well, as I've mentioned, it provides sensible diversification. So we've been managing money at Investors Mutual now for over 17 years, applying our disciplined and prudent bottom-up approach to stock selection. So we look for companies with a strong competitive advantage, those businesses that have a recurring and predictable earnings stream, that are capably managed, that can grow through time, not necessarily high growth, but can grow, that are trading at reasonable valuations. So the value we bring to a portfolio for an investor is that bottom-up discipline, the experience of 17 years in the market, and also the track record of doing that, and the ability to visit these companies regularly. So we're very much a bottom-up stock picker. We spend a lot of time getting to know and getting close to and understanding the drivers of the earnings for our businesses. And that, I think, is a real value add for an individual investor who can't get that access on a regular basis.
Great. Thanks so much for joining me, Simon.
Thanks for your time, Liz.